Well, thanks for that. So we have looked at the DRHP that the company has filed over the weekend. There are a lot of numbers to go through, but we've picked out the best ones for you and taken it as a comparison to how it has been faring with someone like a Maruti, which is the market leader. Now, do note that volumes, of course, Maruti is roughly 3 times that of Hyundai Motor Corp. This is for FY24. The sales volume of roughly Hyundai was at roughly 7.7 lakh units. As well as revenues of revenues of 9 months for Hyundai as per its DRHP of roughly 52,000 crores. But the key thing here to note is the EBITDA margins. Now, despite sales of roughly being 3 times that of Maruti, the EBITDA margins are coming at roughly 11.6%, which is 110 basis points lower compared to that of a Hyundai Motors. When you look at the profitability, of course, the ratio is much higher for someone like a Maruti there, and capex numbers is based on numbers. But let's look at why this particular ratio of profitability is higher for Maruti despite their EBITDA margins being lower. So of course there are 3 key factors that affect the profitability. There is depreciation, which is much lower for someone like a Maruti. Other income component is much higher, which helps the profit before tax to boost up, as well as the tax to profit PBT, which is the profit before tax, is much lower for someone like a Maruti. So we do see here that Hyundai has traditionally been a higher depreciation company too when we compare it to its this is depreciation to the PPE. Other income as well as tax PBT is also in favor of someone like a Maruti. When we move on to the next graphics and we look at what are the other key factors that are one of Hyundai's strongest, is of course the export market. Currently 24% of the sales are roughly in the export market versus 10 to 11% of that of Maruti. We see that they have maintained share. Africa is somewhat affected due to the crisis of the nation, but Middle East and Europe has been one of the key positive for Hyundai Motors. They have doubled their share, and going forward, due to what's happening in Europe with the Chinese car makers, we see that Middle East and Europe will be one of the key contentions here. When we go forward and look at more metrics, when we compare it with Maruti on valuation picture, of course the net worth is roughly 4 times for Maruti higher than Hyundai, but the ROE is one of the key things here. Roughly at around 22% for Hyundai versus 15% that of Maruti, which is a key positive for Hyundai. When you look at market cap to profitability, now this is of course on the assumption that the valuation will be around the $25 billion mark. So if you look at the valuation this is on for the 9 months numbers, which are extrapolated for the full fiscal year. Of course, on market cap to profitability, Maruti is much more cheaper. On EV and EBITDA as well as market cap to revenue, we see that Hyundai might be slightly expensive, and you might be right to think that. But when we look at the price to sales ratio in the next particular graph of Maruti, and we've just taken that for Hyundai Motor Corp itself, the valuation picture seems to be more in line, and we will see that going forward the sales will be increasing for Hyundai. We get a market cap of, this is notional of course, and this is NDTV Profits calculation, of roughly 2 lakh crores. Price per share could be around roughly 2,500 rupees per share. This is on the assumption that 17% of the 812 million shares that the company is going to be offering for sale across NII as well as retail investors will be around this particular ratio. We get an EPS of roughly 70 rupees per share to get the total current value on the current price to earnings are roughly 36 times. Now, going forward, this will be, of course, lower as the company grows its export share. But to give you a perspective, of course, Maruti is currently at 29 times. Going forward, analysts do estimate that these numbers will be closer, and valuation could be a better picture for Hyundai as well, given its higher margins as well as higher export sales going forward. Back to you.